Hi, I'm Dennis Murphy. Welcome to another episode of Sitting Down with an Expert. I'm sitting here today with Jeff Detweiler from Longstreet Financial. Jeff and I have known each other for, it has to be 20 years.
Yeah.
And Jeff is a residential mortgage broker. He's done that forever. He owns the company. He's seen ups and downs and goods and bads and all of that. I used to do title work for Jeff years ago. In fact, when I first, there was a loan officer that worked for Jeff, and he said, hey, yeah, he worked somewhere else, and he came and worked for Jeff, and he's like, yeah, we want your title company in here. And I would call on Jeff, and he'd say, no, go away. And I'd say, okay, and I'd kind of slink away. But me being me, I always say no is only the opening offer.
Yeah.
So then I would go back, and a couple months later, hey, Jeff, let's just try a couple. And he'd say, no, go away. And I'd go away, and then eventually his title company had some issues, wasn't doing what he wanted. So he said, all right, let's give it a try. And we've been working together for the last 20 years since then.
Again, so my name's Jeff. I've been doing residential lending basically since '97, so that's been quite a while. I did wholesale rep for a while, and I did open my own mortgage broker shop back in the day, which the Great Recession got us, in '08. I went back and I got a better degree and opened it back up again in '14. So I've been doing that, and I had some stints at some corporations as well. Doing regulatory compliance, which at some point we're going to get into a little bit of where the difference, where does residential and commercial end. It stems from the regulatory side and risk taking or appetite of the institutions that follow there. So that basically, we'll go a little bit on the different versions of what types of residential lending and how it meshes with the commercial side, because at the end of the day, a lot of the things are the same, although the difference is obviously the devil's in the details.
And really that leads us to our first topic, just the juxtaposition between residential and commercial, and just kind of an inroad to that. I've been in this business for years, like we talked about, owned a title company, so dealt with a lot of residential, so know people that I've known for years that are still doing residential, and they'll come to me and say, hey, I've got a commercial deal for you. Fantastic. What is it? Well, I don't know. The guy's got a bunch of money, and he wants to buy an apartment building. Okay. And, how are we going to split the commission? And my response is, we're probably not. It's just a very, very different process. I always describe residential more as a science, and I oversimplify it, and Jeff, you can retort this, but it's a little bit of, let's put in the information, how much money do they make, how much is the property, okay, we get an approval or a denial, and we go from there. Commercial, there's about 1,000 different components that go into it. You have to underwrite the asset as well as the individual. There might be multiple partners involved in the entity that's borrowing. So again, just quite a bit more really digging into financials of a company, as opposed to on a residential side, really looking at that individual. So when these guys come to me with that, it's always, and if any residential lenders are watching this, yeah, I absolutely want referrals, and I'm more than happy to share a fee with you, but I'm going to do most of the work, and you're welcome to learn, but it is just a very, very, very difficult and more complicated animal. That's my perspective on it. I'm interested in yours.
Well, I agree with pretty much everything you said, and part of it goes back to, again, what I said we were going to talk about is the regulatory aspect. So example, in the mortgage broker world, RESPA, Regulation X, generally basically says that you cannot share any commissions. They have a kickback prohibition against it. And that's where the first difference between the residential and the commercial loans really is. And again, they have the same standards, right? You have your collateral, your capacity to repay, right? Your income, your debt ratio, and then your character or credit, right? Which is, just saying credit scoring models. And there's specific ones that Fannie and Freddie want you to use, but generally, it's the same as anything else. So, so really, residential is 1 to 4 unit home, where someone's going to live there, and it's owned by a person. Now, so you can do some title, some put it in a trust and, close it and insure. But generally speaking, it's for when people are going to live there. there's a, regulation X and Z, which is till and RESPA. They generally are the two that govern almost everything. I mean, there's some other ones that obviously touch it, but those are the two big ones.
And till being truth in lending.
Yeah, till is truth in lending, which is regulation Z.
Right.
And again, Z is a lot of disclosure rules and what both sides have to do, either from company side or from the consumer side. And so that really, once you get out of the 1 to 4 unit family home, and there's regulatory definitions. So if it's going to be, and it really has to do a lot with owner occupied, and again, without going into too much detail, there are differences, whether it's owner occupied or commercial, like an investment property type of a deal.
Well, so let's talk about this real quick. You can, if it's a duplex, I can buy that duplex, live in one side, and rent out the other.
Right.
And is that considered my primary, or is it considered an investment?
If you're going to live there, it's primary. You get one primary.
Even though it's a duplex, so
Yep.
I can gain income from the other side?
Up to
and-
4. Yep, I did a deal last year, and it was up in Pontiac, and it was around 400 grand, but it was this beautiful big old house, and there were 3 units, and they were each probably around 2,000 square feet, give or take a little bit, right? This is just easy talking. And the rent from the other 2 units pays the guy's note, and it's owner occupied FHA
Nice,
because he lives there.
nice.
So
I think there's some confusion there, and that's why that's really why you're here. Those lines blur in certain places, and there's times, and we'll talk about this in a minute, where residential can work to get you the capital to buy your business and that type of thing, but I want to talk about those types of things. So you said, so you can live in even, one of a quad as
Yep.
well as one of the duplex and still use it as your primary.
Yep.
And then you talked about up to 4 units. So let's talk about that. Why did you stop at 4 units?
it's really regulatory based. That's the rest of the rules and the TIL rules. They pretty much define residential lending as 1 to 4 units, with people in it. And so you can do, a lot of times you could do a commercial loan on a property just, on a normal subdivision. But one of the things you're gonna have to guarantee in your document package is gonna be proof that you're not gonna live there. Because if you say you're gonna live there, then the regulations apply. You can't just say, oh, well, he said it was for his company, so, so we don't have to follow that RESPA or truth in lending rules. No,
Right, we kind of want to go commercial. It's
Yeah.
looser,
Yep.
but then we want all the benefits of residential.
Yep.
Doesn't work
and
that
they won't let you get away with that, and and that's just kind of how it is. And so there's some gray area, which is like a 5 to 8 unit apartment building. You start to get into an apartment building type of a situation, and some places will they'll basically extend the restrictiveness of the 1 to 4 units to the 5 to 8s and allow you to do them as residential, even though technically they're really not. And then of course you have the FHA, of course, does large residential complexes, which is not normally what they do, right? FHA, for example, is pretty much all consumer primary. You get one house that you live in, but FHA does like some Section 8 housing type of things like that.
And that's really, and correct me if I'm wrong, because in my world, that's where we start. We can do, so I'm doing an apartment building in Detroit right now, and it's still going to be FHA.
Right.
Right. Well, it's going to be Fannie.
Right.
So it's under that HUD umbrella.
Right.
So I think what we're saying is this box is residential. It's like a Venn diagram,
Right.
right?
Yeah.
And there is that little circle in
Yeah.
the middle.
And there's spots where you can kind of go either way,
Right.
but again, it's really going to be the documentation and the banks and the lenders and those types of things are going to be following a certain regulatory regime that they're going to want certain things documented in order to say it's this or that.
Okay.
So you can do it one way, but you can't do it the other way. And again, it just depends a little bit about what is it, it looks like a duck and walks like a duck and talks like a duck.
Well, and you and I have referred back and forth kind of on that line. This really pushes into commercial dense, can you pick this up?
Yep.
And I'll have somebody call me up and say, yeah, I wanted, we had one, I think it was last year or so, somebody, they had a ton of equity in a multi-million-dollar house.
Mm-hmm.
So it was okay, I could get you a commercial loan for this property that you want to buy, or I could send you over to Jeff. He'll do the residential loan that's going to be at a cheaper rate.
Yep.
He'll help you pull that cash out, and you buy that property with that.
Yep.
Your net cost of funds is much lower. So we lob it back and forth
Yep.
over the commercial and residential net.
Yep, and that's where they can really work together, right? Because if you have a small entity, right, so you have a person, right, and she owns a house and she wants to buy a business or owns a business, at the end of the day, all of the money comes out of her pocket. So if you can find a way that makes her, you know, legally comfortable having it come out of her residential pocket, then you can say, right, okay, we'll take the cash out of your primary residence, and you may, either whether you had a small loan or no loan, now you have a bigger loan. But because of the primary mortgage market, your rate's gonna be, you know, 2, 3, 5% cheaper, and your payback terms are gonna be longer, which means your cash flow is gonna be greater, right? So, you know, where I might give someone pretty easily, if you want to come to me and say, hey, I'd like a 30-year fixed mortgage, and I'm not going to bat an eye. That's fine, 30 years, pay it back little at a time. That's actually the standard. Whereas I think you would agree, if someone comes to you and says, I want a 30-year commercial loan fully amortized, probably not attractive terms.
Until we get into capital markets, which is going to be several $1 million, but yeah, for that smaller market, no, it would not be attractive.
It's really, if you've got a 1 to 4 family house, then it can almost always be done as some sort of a residential type deal. In some of the larger homes, I mean, you can still do them residential, and there's some hybrids, which, you know, the old subprime, the new non-QM, non-qualified mortgage, which is, you know, an offshoot of the new regulatory that came out a couple years ago. So it's really, once it starts to get outside of what you would consider a normal home, right? You get a home that's non-conforming zoning, right? It's still a house in an industrial zone, and you need a letter to rebuild or something like that.
Right.
So once it gets weird, then it tends to go a little more commercial, or when it just isn't a house, right? If you've got you know, some of the old lofts, you know, now they're kind of a little more mixed use. But if you get, you know, an old church that you want to live in, right? And that's kind of more commercial, because look at the building, right? It doesn't lend itself to, you know, a single family living there.
Could be zoning as well.
Could be zoning. So that's really when it switches,
right?
Because the loan to value, right? How much they're willing to lend based on the value is, in my opinion, almost always going to be better if you can put it into the primary mortgage market. I mean, we can lend, you know, pretty easy up to 97% if someone's buying a house, and that's, you know, Fannie and Freddie, whereas commercial generally doesn't go that.
How many single-family residences can somebody own? So obviously I have my primary, but then I'm doing, you know, I love 3-bedroom brick ranches in this economic area.
Yep.
How many of those can I do before residential says, nope, you've hit your limit?
So generally speaking, 5. You can have your owner-occupied one and 4 other ones that you have a loan on. So you can own 812,
sure,
as long as you only have a loan on 4.
Right.
So obviously you can, you know, if you've got a couple big ones that are paid off, maybe you take a big mortgage and pay off 2 of the other ones. And that's for your primary market, right? Your Fannie Mae, your Freddie Mac, a lot of banks. Now, there are places that have, you know, whether it's portfolio lending, a bank might have a portfolio where they like those kinds of loans, and if you have a relationship, they may give you close to the same type of a deal, but it's really just a concentration type thing. And Fannie and Freddie pretty much, their rule, the FHFA, the Federal Housing Finance Authority, the regulator, has said, yeah, this is the number to where it kind of turns into more of a commercial type deal.
So that's when, if somebody comes to you and says, I've got a portfolio of 50, you say, awesome, let me get IBC on the phone, they're going to take care of it. So, and this is good for any investors that are watching this. Oftentimes people will come to me and say, I have an investor who will buy in packs of hundreds. You know, we did a 300 unit pool. It's not easy to place. We have sources for that from a commercial standpoint. So the question is, why isn't it easy? If a bank has a residential department and they have a bunch of residences, why not just have a bunch with one guy? The problem is when you get into commercial and you have a finite amount of labor and resources, you tend to not want to invest those resources in a bunch of little properties, because you've got a bunch of appraisals, you've got a bunch of title work, you've got to go and check your portfolio every year. So now you might be going all over town for all of these. It takes a lot of time and effort and money spent. Whereas if you had an apartment building, all of your doors are in one place, you get a rent roll, you get the tax returns, boom, it's all right there, you can go visit it. So that's why there's a lot of lenders that don't like those you know, let's say 50 to, you know, several hundred units. But we do have those lenders, and absolutely, you know, that's where the residential guy, the guy, you know, decides, okay, I'm a contractor, I'm going to start with one. Well, that went well, I'm going to start with two. And Jeff's doing these for him.
Yep.
And then when he hits that 5, Jeff says, all right, now it's time either on your next one, you need to go to see Dennis Murphy at Independence Business Consulting, or have him just redo your whole portfolio, pull money out of that, and we can do a line of credit, and that will help you buy your next ones. There's a lot of ways to skin that cat, but that's when it kind of graduates, for lack of a better term, from residential to commercial.
Yep, definitely.
Any thoughts to put a pin on that one? Or?
Just to add that a lot of banks, so a small bank, you said, well, you know, all my houses are in this this community. You know, I'll just go to my local credit union or something to get this loan of, that's going to securitize 50 houses. They also have the banking rules will fall into them, or the credit union rules, which say that, you know, investor concentration, you can't give too much money percentage-wise to one person, right? And so that's, to me, really where it goes, is that the small banks, they don't want to run afoul. They don't want to put all their eggs in one basket.
Right. There's a reason those regulations are in place.
Right. And then the big boys, for lack of a better term, they make enough money on their other stuff. They don't want to deal with what Dennis said, where they have to monitor their commercial portfolio and get, you know, some sort of evaluation on 50 properties that, you know, may all be only worth 50 or 100 grand on a good day, right? And deal with the rents. And one of the things that a lot of people don't always fully comprehend is when something goes bad. You know, if you are at a 70% loan to value on a $500,000 house, there's $150,000 in equity that the lender can use for a quick sale to pay their attorney, right, to take the house from you. If you got a $100,000 house, that's only 30 grand. I mean, when you figure what it's going to take to rehab and sell and you know, evict the people and do a foreclosure action and hire attorneys and, you know, all that stuff, all the money's gone. It's negative money. So they don't want anything to do with the little stuff, which, you know, you can argue how that's not the regulatory outcome that they wanted, but that is how the world works.
Right. Let me, before we move on to the next topic, I want to revisit. Jeff introduced himself and was pretty modest. Let's talk about that. I remember getting a call from Jeff years ago after kind of the market had turned and we were all, you know, pivoting after 2008. And Jeff called me up and said, you know, I'm thinking of going to Booth. And I'm like, I don't know what Booth is. And then I looked Booth up and realized it was Booth Business School out of the University of Chicago. And it is one of the top business schools in the world. And I'm like, oh, okay, that seems pretty apropos for Jeff. He's not just going to go to the local community college, he's going to go back and get his master's from Booth. Yeah. And he did. And I think, were you living in Ohio at the time?
Yeah, I was living in Ohio and working at Chase.
And you would fly on the weekends to Chicago, right?
Executive program for two years, and it was every other weekend, from Friday to Sunday, and then they had we had a week in London and a week in Singapore, or 3 or 4 different weeks where we were just in Chicago. Okay. Because they had 3 campuses.
And you graduated and killed it, and you know the connections that you've made that we've talked about and even interacted with. So when Jeff says, yeah, I went back to school, it's a little bit modest, and it does speak to his expertise level. And also, you know, you can see Jeff's slant towards compliance as we talk about this stuff. Well, that's because he was a compliance person for multiple banks and was a consultant who was pulled in to, you know, and I'll let you kind of speak to that, some of the things you've done within compliance and some of these consulting gigs.
Right. So A couple of the interesting ones that I got to be involved in were part of the fallout from 2008, the financial crisis, was their master servicing consent orders for the major banks. So it was a huge consent order remediation project, and I was hired by Chase to be one of the three people who were actually doing the work. Obviously, they had a lot of head people who were running the show. At Chase, you would expect that, but so there were a couple of us that we were. At one point, I was in charge of all, or 1/3 of all of Chase's foreclosures, and we actually shut them down in 2011 for a couple of months because they were worried about the robo-signing and those types of issues that existed at the time. So Chase just stopped foreclosing. Right? And then the OCC came in, and they ended up settling, I think it was $5.7 billion just to make it go away. And then later on, I was at a consulting firm, and we did U.S. Bank. We helped them get out of the same one, even though it was like 2 years later. They couldn't. I don't know if they didn't want to pay the fee, or if they just couldn't seem to get out from under it. So we helped them get out from under it. And so it's definitely been interesting.
So you've seen the other side. Everybody loves to originate, and it's exciting being at the closing and all that. But there is another side, and that does go into whether it's residential or commercial. Oftentimes, clients will say, well, why should I have to take a lien on my home? So, IBC facilitates commercial loans for our clients. Oftentimes, it's startup or expansion, and there might not be the liquidity needed, especially in a startup. So, we help people, we put them in position to talk with financial advisors, possibly do loans against their 401k or liquidate some securities, that type of thing. But for most people, what's their biggest asset? Their home. So there's always that balance in commercial lending. Well, you have to have injection. So the building is $1 million. You have to have 10% into that, okay? You have 50,000, you need another 50,000. How do we get that? And then if you had, let's say you had 100,000, okay, I put the whole 100 in, now the underwriter says, well, you don't have any liquidity left after this. What happens if something goes wrong? What if they don't pay their rent, So, and that's when people just get so frustrated with the process. But from the lender side, and we talked about your compliance history and dealing kind of with the other side of lending, and not the good happy, hey, we went to closing and here's the champagne popping and this is the house you're going to live in forever. There's the foreclosure side and what banks went through and the unraveling that you were a part of so many of those foreclosures. And you talked about that a little bit earlier in the conversation. So there is validity to an underwriter saying, hey, we do want to turn over every rock, and at the end of the day, do you have ability to pay? So I know it's funny when they say, okay, put all this money into the injection portion, but leave enough liquidity so that you have operating capital going forward. And it almost seems like they're contradicting themselves, but the answer is no, we want all those things. And a true entrepreneur will find a way to do that. So one of those ways, and the primary way, again, your biggest asset oftentimes is your home. So I'll have Jeff talk a little bit about, okay, what makes sense in refinancing. Do you do a term loan? Do you do home equity loan? Especially where we're at right now with rates. But oftentimes clients will say, well, the lender wants me to put up my home as collateral for this? And the answer is, well, yeah. So you're saying that you want the lender to put up hundreds of thousands of dollars, or in some cases millions of dollars, but you're not willing to risk your home? That makes no sense. So you've got to be able to put your neck out a little bit and have some skin in the game, and the lender's willing to do the same, and you're in it together. So that leads me to, yes, they'll put a lien on your home, so oftentimes, especially on an SBA. So certainly you might as well use some of that liquidity in your home to put that injection money in. Sometimes even more injection money than you need, because residential interest rates are always going to be lower than commercial rates. So pull as much as you can out, put as much cash into the deal as you can, so your commercial loan is lower, maybe your residential loan is a little bit higher, but your net cost of funds, as we talked about earlier, is lower. So I've made that call to you multiple times throughout the years.
Yep, no, and that's definitely a good way to get capital. And there's also, in addition to those, it's also sometimes about how you can pay off. So your credit score, both for business and for personal, is one of the major drivers. If you can hit the magic 700 number, banks tend to like you. 699, they don't. 701, they're like you just the same. So one of the interesting things is we have tools. There are tools. They don't really give you their actual scoring model, but you can use the credit reporting agencies and the bureaus to tell you what to do to increase someone's score, because usage is one of the greatest things. Right? It's also payment history, right? If somebody has never paid a bill in their life, usage isn't going to help. But if you have somebody who obviously is relatively successful and is venturing out and expanding and doing that, they're usually in a fairly positive financial position. You can take cash out, meet the liquidity and the injection needs, and at the same time work on their debt. So their out goes low. If you pay off a house or a car and a couple credit cards and some other things that are worth paying off, you're going to raise the monthly cash flow of the person, which helps in almost all things, but you're also going to help their credit score, which in my experience, I think yours as well, is really going to help the lender when they look at the deal. It's so much easier if they look at it and they say, this person, has stellar rating, a stellar number, and they're definitely paying me back. It's just so much easier.
And oftentimes people will say, well, what does a lender care about my personal credit? This is a commercial loan, and vice versa. So the answer is, it's creditworthiness. You've got a history here. So if you've been late on mortgages, you've been late on credit cards, you've late on all this, but I'm going to totally pay you back. This one is going to be great. No, I don't think so. I can only go off of your history. That's why that's used. So I always have my clients pull their own. I have them use Experian. I have them, pay 20 bucks, get on there, get the tri-merge, the 3 credit bureaus, get your score, and get a full detailed history. And you can bring that to us and we'll take a look at it and say, okay, we need to clean some stuff up. Oftentimes, one of the things that's holding your credit score back is high usage. We want to keep that generally under 30%. So oftentimes it might be 1 or 2 things that are really driving that up, driving your usage up and driving your credit score down. So we'll say, hey, you've got $100,000 in the bank. Why don't you take $20,000, pay all that off? Now we'll get your score up around or above 700, and you're going to get better rates. It's easier to approve you, all of that. And oftentimes over the years, I've had people that I cannot get done right now because credit is too bad. I'll call Jeff up and say, hey, will you work with these guys? A, you're just used to it from a residential standpoint, cleaning people's credit up, but B, maybe we have to do a refinance of their home to pull the money out to pay off that debt so we can get them into the loan.
Yep, and sometimes it's just that the couple percent on debt ratio makes all the difference between a deal, jumping the hurdle to get it done or falling short. And it can be very easy to do that, especially with the residential loan. They really, to a certain extent, the residential can help put you in a position to either get the commercial loan done right now at more favorable terms, or put you on a path to where even in a month or 2 you can go ahead and then apply, because they do take a look at the upcoming debts of the commercial loan and residential and all those things.
Well, let's talk about debt to income ratio, which would be a residential term, and debt service, which would be a commercial term. So debt to income ratio is just that. Here's what I make, here are my debts. I fall into what's going to get you approved, what ratio?
So in the residential world, again, add up your W-2s, right? If you're just a W-2 employee, right? Add up your W-2 numbers. That's your annual income divided by 12 is your monthly, right? Take your debt on your credit report, right? So they don't care, that you go to eat and that type of a thing. They don't count those types of things. Like some commercial loans, I think, do. But you want to know your car payments, your house payments, your credit card payments, your RV, your boat, whatever you might have. You add those up, you divide it. And so, generally speaking, there's a housing ratio, which your Fannie and Freddies, they really like it around 28 to 30%. Then there's the back end ratio, which is all inclusive of all of your principal, interest, taxes, insurance, your house, your car payments, and credit and all that. And they like to have that be around. Technically, they love it if it's under 38, 43, you're okay. FHA is a little more lenient, but once you start getting into 50, 60%, it starts to be in the no-go zone.
Right. Good chance that that stress model is going to crush somebody.
Yep.
They're not going to be able to afford this home.
Yep.
We've got to look at something lesser. So the counterpart to that, the cousin to that in commercial, is your debt service. And generally we look at it as debt service of the asset and global debt service. So kind of combines debt to income ratio and debt service of the entity we're purchasing. So I always describe it as a bucket. So you ladle into that bucket your personal income. It can be your W-2 income, any investments that you have that are generating income. We pour all that water into the bucket. And then we look at all of your personal debts. We've got to ladle those out of the bucket and see what's left. And then after that, and this is what makes commercial a little different, then we have to look at the debt that we're about to put on the asset. So we're buying $1 million apartment building. The loan is going to be, $11,000 a month, so we've got to ladle that out. But we also have to ladle out capital expenditures. We're gonna forecast that. So we're gonna have to clean the windows. We're gonna have to fix the roof from time to time, fix the HVAC system, the boiler, whatever it might be. Taxes, insurance, all of that. Then we start looking at the income, right, that we're gonna generate from this asset, whether it be an apartment building or a manufacturing company or a Jimmy John's down the street. They're all going to generate income, so we pour that into the bucket. So at the end of the day, where Jeff, you said the debt service ratio is, they like it under 48%?
Yeah, back end right, generally.
Okay.
45, you can go up to 50, you can get up to 60 and so on.
But 45 to 48
You're
is
safe,
where you're
yeah.
going to skate through pretty easily. So in a commercial world, in that global debt service, the water in and water out of the bucket, they're looking generally for a 1.25 debt service ratio, meaning $1.25 coming in for every dollar that's going out. Now, just like FHA is a little bit more lenient, SBA will be a little bit more lenient. Technically, SBA will go all the way down to a 1-to-1 ratio, which is interesting. Not a lot of wiggle room there. You have a couple of bad months and now you're at a negative debt service. But remember, SBA also gets approved by the SBA and the bank. So the bank generally won't let it go down to the 1-to-1 ratio. They'll want to keep it at the 1.25. And depending on the risk tolerance, they might go up to a 1.33. So $1.33 coming in for every dollar that goes out. And to me, that's the biggest similarity and difference in how we calculate, because on residential, we're looking essentially at this individual on this property that's not going to generate any income. Commercial, we're looking at that individual and we're looking at the entity that he's getting the loan on and all the money that comes in and the money that goes out to support that debt. So I think we covered here what is always the goal in these interviews with an expert. There's oftentimes confusion about residential and commercial, and again, where they begin and where they leave off. And we got into a little bit of rules and regulations. I think one of the biggest takeaways is oftentimes entrepreneurs, the biggest hurdle into getting into business is startup capital. So one of those takeaways is use your home. Yep. And I do it all the time. Jeff, can you refinance these people or do a HELOC? Any thoughts on term loan versus HELOC, home equity line of credit, to get that capital to start the business with?
So under most times in the market, I would say just do it. You can get a little better deal if you just refinance your primary, right? And so then you have a first mortgage and do it, basically it's cash out first mortgage. Now with the rates really going up a lot over the last couple months and some uncertainty, you might do better keeping, if you have a low first mortgage or no first mortgage, you might do better to do a HELOC, which is a home equity line of credit. It's basically what most people think of as a second mortgage, although if your home's free and clear, you can still do one. So they usually have overall the rates are a little higher, but the payments are a little lower because they generally don't have, there's a period, the draw period is usually 10 years. It varies by institution, but where you just pay interest on the debt. So it doesn't, so if you borrow 200 grand, 3 months from now you still owe 200 grand. You've made 3 payments. Whereas in an amortizing loan, the mortgage, it will, right, you'll pay a little more, but you're also paying it off. So I think that that's better for long-term planning than having a deal out there that will either balloon, right, which means like 10 years from now you got to bring that 200 grand, in a check, send it in on Tuesday, or you have to, then it'll amortize, but instead of being a 30-year amortization schedule, right, so your payment on that 200 grand, instead of being $1,000, and I'm making up numbers, on the monthly payment, interest-free, it would have been $1,200 on a 30-year amortization rate on the first mortgage, but now they're going to do it on a 20-year amortization, so your payment's now $1,500 for the next 20 years, and there's nothing you can do about it other than refinance at that point. So it really is just what you're planning on, and where you are, and the different things. Each person has a different reason. I tend to just default to the 30-year fixed because you can always refinance. Right, it's a one-sided option basically. If rates get better, you refinance. If they get worse, you do nothing. Because you never have to do anything, right? And you can always pay more. You can turn a 30-year loan into a 10-year loan by paying. You can do the math and figure out the number.
And obviously, if your business does well, you can pull money out of that business and throw that money down, essentially paying yourself back. It's an owner's draw, and your accountant will account for that. Yep. But there's, it's not, oh my God, I'm going to be saddled with this debt forever. You're in business to make money. Whatever it takes, I always describe it as I've got this race car. I need racing fuel to get going, to get into the race. That's the capital that starts you off. Sometimes you go to friends and family, you go to equity investors, and we'll do a segment on that at some point. But in this instance, you're borrowing essentially from yourself, from the equity in your home. But again, you're in business to make money, so once you start rolling in your business, you can throw some of that money back on this mortgage.
And one of the interesting things about doing the residential or even the commercial debt, right, is if you look at the hierarchy of what capital costs, getting it from yourself, from leverage and debt, is always going to be cheaper than getting it in pretty much any other way, especially in residential. I mean, there's rules, but there's, if you're primary residence and you borrow money against it, you're able to write off the interest. The interest is lower. There's a whole bunch of different things that are tax advantaged for you, versus, if you're going to go out to, mom and dad, they'll probably give you some reasonable terms. But after that, people are going to want more and more, and you get into hard money, or you get into loan sharks, or even the current payday lenders of the day, right? Your upstarts, your upgrades, the companies that you get these solicitations in the mail, or you see them online. Click here and you're approved for $40,000. Yeah, the rates are, they're using a Utah bank. The rates are 29%. Right, 29% of 40 grand. I mean, it's literally usury in our state,
right?
But it's perfectly legal because of the rent-a-bank model of the regulatory regime that's out there, which is a story for a different day, maybe. But but it just gets more and more expensive, and equity can be very expensive as well, right? If you give 10% of your company to somebody, I mean, they're still going to want a return, and now they own the place, and you're giving them a return. I mean, equity is more expensive than debt.
And at some point, you might want to buy them out, and they're only going to sell at a premium.
Yep. So especially if things are going great.
And that's a good point. Is if you can, especially if it's an investor that isn't adding anything to your business. So oftentimes you get an investor, but he's a mentor, and he or she is a mentor, and they've been in this business for years, and they're really going to bolster your business. That's great. But oftentimes it's just, hey, do you want to invest? I'm doing this venture. Yeah, I'm going to want a premium on that. I'm going to, I want to buy 10%, so I get my dividends of 10%, and then when the day comes, you want to buy that 10% back. Well, why would I do that? Your business is growing, so there'll be a premium to pay back. So, like Jeff said, if you can borrow from yourself, that's the best way to do it, if possible. All right, so I think those were some pretty good topics, and topics that are confused often. And again, when I get referrals from residential lenders or somebody that knows enough to be dangerous about residential, well, why would we go to capital markets? Why would we do this when, I know that, my neighbor, they just refinanced their house, and well, totally different worlds. Commercial's a totally different world.
Yep.
And we've got all those options when we graduate to the commercial realm that we can take you into. And like I said, I call Jeff all the time for, hey, these people just need some money, they've got some equity in their house, can you take care of them? Or they need some help cleaning up their credit. It might be a few months before we can get them any commercial funding, but if you can get them residential lending, pay down their credit cards, now they can come back to me and we can get them financed. I think those were the main takeaways from today. So as we exit, if you want to do a little plug for Longstreet Financial.
Longstreet Financial, we're a small mortgage broker. There's a few of us on my team, and I have licenses in Michigan, Ohio, Pennsylvania, California, Florida, and Tennessee are where I can originate residential loans. And commercial loans, so just as a side, if you're doing like an Airbnb type of a lending, they do have some residential small commercial type loans at the SCI, the debt service coverage ratio loans. And most states you can do those. So if you said, hey, I wanted to, in Texas, I want to get a rental house, maybe you can do those too under those terms. But
okay, I didn't know that.
Because they switch into commercial, which again is a different how you're regulated. And
right.
So they'll allow commercial loans because it's really the residential, when they're defined as residential, the regulations take into effect, right? And they're the customer must be protected. Whereas when you go to commercial, it's not that the customer isn't important, but it's that everyone should be informed and rational enough and educated enough to make sound business decisions. Whereas, from the regulatory regime, the consumer is not an educated person,
right?
So they have to be protected from people like us.
Right. No, and I think it's one thing to have your home loan. That's the roof over your head. There needs to be protection there. But if you're going out and you're investing, there's inherent risk in investing. Yep. So they're going to assume that there's a little bit more research that's gone into that, a little bit more disposable income for that, and I think that's the separation.
Exactly right. If you're buying the business you work in, making widgets, you're going to know a lot about the widgets and if it's a good deal for you. And if you're going out and buying a 12-unit apartment complex, again, it doesn't really matter where. They would think that you've done your due diligence.
Right.
And there's a buyer and seller and a meeting of the minds, and that you, for whatever your reasons are, it's a good enough deal that you're good to go. So, yeah.
And if you're just going into that world, Independence Business Consulting helps you with that as well. We guide you through that whole process, the negotiations and all that. All right, thank you for sitting down with me today.
Thanks for having me.
I appreciate it.